All right, let's talk about Griffon Corporation. This is one of those companies that has Wall Street totally split. You've got some folks saying it's a hidden gem, while others think it's a super risky bet. So, which is it? Let's dig in and find out.
So check this out. It's a $4.4 billion company, and analysts are basically screaming strong buy. But, and there's always a but, right? Some of its key numbers are throwing up some pretty serious red flags. So what's the catch here? That's what we're going to figure out. Let's peel back the layers and see what's really going on.
Okay, so before we jump into the whole bull versus bear debate, we've got to understand what Griffon actually does. At its core, it's a holding company. Think of it like a parent company that owns a couple of different businesses. It's all split into two main parts.
So here's the breakdown. Their business is basically split right down the middle. You've got home and building products, or HBP. This is all about stuff for construction, garage doors, rolling doors, that kind of thing. Then on the other side, you have consumer and professional products, CPP. This is the tools side of things. Everything from heavy-duty power tools for pros to the hand tools you might have for a weekend project.
Right, now for the fun part, the numbers. This is where we get a real financial snapshot and see how Griffon stacks up in the market right now.
First up, the share price. Right now, it's sitting at about $94. And what's interesting is that it's hanging out right near its 52-week high. That tells you there's some real positive momentum behind this stock lately.
So with that share price, its total market cap comes out to around $4.4 billion. To put that in perspective for you, it's what we'd call a mid-cap stock. It's not some tiny startup, but it's definitely not a behemoth like an Apple or an Amazon. It's in that solid middle ground.
Okay, and here is where things start to get a little weird. Take a look at its trailing PE ratio. It's 98. Yeah, you heard that right, a whopping 98. Now, just for context, a normal PE for this kind of company, maybe 20, maybe 30. So a number this high immediately makes you think, whoa, is this thing way overvalued? It's a huge red flag. So what is going on here?
So let's quickly break down what a PE ratio even is. It's just a simple way to compare the company's stock price to how much it's actually earning. When you see a super high number like Griffon's, it typically means one of two things. Either investors think it's overvalued, or they're expecting absolutely explosive growth in the future. It's a bet on what's to come.
And this is where we start to find some answers. Look at the forward PE. It drops all the way down to a much more reasonable 17.9. See, that number is based on expected earnings, which tells us that analysts are incredibly optimistic about the future. You also see a really strong return on equity, which is great, but then there's that debt-to-equity ratio. It's pretty high, which means they're using a lot of leverage, a lot of borrowed money to get those returns. And that, of course, adds a layer of risk.
So all of that optimism brings us squarely to the bull case. Why are so many people on Wall Street excited about this stock, even with that crazy trailing PE? Let's get into it.
Well, for starters, you've got the big players weighing in. I'm talking about firms like Deutsche Bank and Loop Capital. They've recently initiated coverage, and they've both come out swinging with buy ratings. They're setting price targets up in the $101 to $103 range. From where the stock is now, that implies some pretty serious upside.
And this optimism isn't just wishful thinking. It's grounded in some pretty solid fundamentals. First off, Griffon consistently beats its earnings estimates. That's a great sign. Plus, get this, over 75% of its stock is owned by big institutional investors. That's a massive vote of confidence from the smart money. Add to that the fact that it's a cash-generating machine, it's got a diversified business, and its profit margins are looking really healthy.
But, like I said, it's not all sunshine and roses. For every bullish argument, there's a bearish counterpoint. And there's some very real risks here that you just can't ignore. So now, let's flip the coin and look at the case for caution.
And this really gets to the heart of the debate, the fundamental tug-of-war with Griffon. The bulls see strong operations and tons of cash flow. The bears look at the same company and see a ton of debt and a business that's way too dependent on the whims of the housing market. It's two completely different interpretations of the same facts.
So what specifically is keeping the bears up at night? Well, that high trailing PE for one. The valuation just looks stretched. Then there's the cyclical risk. If the housing market slows down, Griffon's revenue could take a major hit. That debt we talked about, it could become a real anchor in a downturn. Plus, the performance between their two business segments has been a bit mixed. And maybe the most telling, insiders have been selling shares lately, not buying. That's never a great look.
Okay, so we've laid out both sides of the argument. You've got the bull case and the bear case. So, how do you possibly decide?
Well, the truth is, the key isn't about making a final call right this second. It's about knowing what to look for going forward. So here's your go-forward framework, your investor watch list. Number 1, keep a very close eye on their upcoming earnings reports. What are they saying about their outlook for the rest of the year? Number 2, watch those margins. Are they staying strong or are they starting to get squeezed? That's a huge tell. Number 3, capital allocation. What are they doing with all that cash? Are we seeing dividend hikes or new share buyback plans? And finally, number 4, watch the macro data. You have to keep an eye on the overall housing and construction market. That's going to be a massive driver for this company, for better or for worse.
So when you put it all together, who is a stock like this actually for? Well, it seems best suited for a long-term investor, someone who has the stomach for the ups and downs that come with cyclical industries. If you're okay with a bit of volatility, this could be interesting. On the flip side, if you're looking for steady, high dividend income, or you're just generally trying to avoid risk, this probably isn't the one for you.
And that brings us right back to where we started. Is Griffon Corporation this smartly diversified company, poised for major growth? Or is it a business that's just a little too tied to an economy that feels, well, pretty uncertain? The bull case is compelling, but so are the risks. Ultimately, the future of this stock depends on which one of those stories plays out.